Have you ever looked at a broad market index and thought, how exactly do they decide who gets the biggest slice of the pie? Welcome to this explainer. Today we're totally geeking out and breaking down the anatomy of what is honestly a fascinating modern market index, the Nifty MidSmallcap 400 50/50.
Okay, let's quickly run through our agenda so you know exactly where we're heading. First, exploring mid and small caps. Number 2, enter the 50/50 index. 3, the 50/50 calculation method. 4, meet the top constituents. And finally, 5, rebalancing and real-world use.
So I want to start by throwing a really critical question your way. How do we actually capture the massive, and I mean massive, growth potential of mid and small cap stocks without one group completely overshadowing the other? It's kind of the classic headache in index design, right? Because when you mix medium-sized companies with smaller ones, well, those larger mid-caps tend to totally drown out the smaller players. And that means you could completely miss out on that unique, aggressive dynamic of true small-cap growth.
Section 1. Exploring mid and small caps.
Now, standard market cap weighting, it naturally favors the bigger guys. It often allows those mid-caps to completely eclipse the small-cap growth. It's almost like putting a heavyweight and a featherweight on the same seesaw. But balanced segment capping, that's a real game changer. It solves the issue by drawing a hard line. It ensures both segments get an absolutely equal platform to drive the portfolio's performance, rather than just letting the sheer size of the mid-caps dictate the whole shebang.
Section 2. Enter the 50/50 index. To fix this exact weighting problem, the National Stock Exchange went ahead and designed a highly specialized instrument. Enter the Nifty MidSmallcap 400 50/50 index. Launched recently on February 4, 2026, this index is basically a specially capped version of the broader Nifty MidSmallcap 400. It brings together exactly 400 constituents across the mid and small cap spectrums, but here's the kicker. It forces them to play by a very, very specific set of rules.
Section 3. The 50/50 calculation method.
The golden rule here is a strict allocation mandate. Basically, the 150 mid-cap stocks, which make up the Nifty MidCap 150 segment, and the 250 small-cap stocks from the Nifty SmallCap 250 segment are forced into a rigid, non-negotiable 50/50 split. No matter how much the collective market cap of that mid-tier swells over time, their aggregate weight is permanently capped at exactly 50% of the index's total weight. That ensures the small caps can fiercely hold their ground with their own 50% slice. Now, you might be wondering, what happens inside those two halves? Well, within those two fixed 50% buckets, the individual companies are weighted by their free float market capitalization. Essentially, that means only the shares that are readily available for public trading dictate a company's internal rank. So, the most actively traded mid-caps dominate their 50% allowance, and exactly the same logic applies to the small-cap half. It is beautifully symmetrical.
Section 4. Meet the top constituents.
Think of index weighting a bit like a recipe. Because of that 50/50 segment cap, literally no single company or even a single sector can come in and overpower the index. I mean, look at this. The absolute heaviest hitter in the mix, BSE Limited, takes up just 1.93% of the total index, not even 2%. It's followed by Federal Bank at 0.99%, the Multi-Commodity Exchange of India at 0.89%, Suzlon Energy at 0.88%, and Hero MotoCorp rounding out the top 5 at 0.76%. Notice how this naturally spreads out the sector weighting too? Sure, sectors like financial services and capital goods are heavily represented, but those hard caps prevent them from running away with the entire index. The risk and the growth potential are spread out so efficiently.
And let's not forget the rest of the pack. Beyond those top 5 heavyweights, there are exactly 395 other distinct companies sharing the load. We're talking broad market representation across dozens of diverse sectors. We aren't just riding on the coattails of a few hot stocks here. It is a massive, coordinated effort across 400 distinct businesses driving this overall index forward.
Section 5. Rebalancing and real-world use.
So let's look under the hood at how they actually manage this thing in the real world. The index is tracked from a base date way back on April 1st, 2005, with a starting base value of 1,000. Now, they reconstitute it semi-annually, which basically just confirms the list of 400 constituents every 6 months. But the absolutely vital mechanism here? That is the quarterly rebalancing utilizing January 31st and July 31st cutoff dates. Because as we know, stock prices drift up and down every single day, right? So that perfect 50/50 balance naturally gets a little out of whack.
This quarterly rebalancing is the strict rule that literally forces those drifting segments back to their rigid 50-50 ratio 4 times a year. Because it is so meticulously maintained, this index becomes an incredibly useful tool for benchmarking portfolios or serving as the rock-solid foundation for index funds and ETFs.
I want to leave you with a final provocative thought today. How might a 50-50 capped index actually change your own approach to finding true, balanced diversification in the market? Think about it. When you mathematically force balance like this, you prevent the big guys from entirely drowning out the small ones. It gives true innovation across all 400 companies a real chance to shine in your understanding of the market. Thank you so much for joining me on this explainer. Keep analyzing, keep focused on those fundamentals, and I will catch you next time.